Welcome to the Daily Market Recap. Today is Friday, July 17, 2026. Wall Street just hit a massive speed bump. The markets took a nasty spill today, with the SPY dropping 0.8% and the QQQ getting absolutely hammered, falling 1.7%. The main culprit, a brutal widespread meltdown in artificial intelligence and semiconductor stocks. Despite massive earnings beats, investors panicked over heavy capital expenditures. Compounding the pain, geopolitical tensions in the Middle East expanded as U.S. airstrikes hit Iranian targets, pushing oil prices sky high and igniting fears of inflation. It was a classic risk-off day where the bulls were forced to run for cover. Looking at these sectors, it was an absolute bloodbath for technology and growth stocks. The semiconductor casino was in full swing with massive pullbacks in big tech names, but it wasn't a total loss across the board. Capital didn't leave the market entirely. It rotated straight into safety blankets. Consumer staples, healthcare, and real estate sectors all saw significant bids as defensive rotation took hold. Energy was the only growth-adjacent sector holding green, riding high on surging crude prices. If you weren't hiding in defensives today, your portfolio definitely felt the squeeze. All this chaos has sent the greed and fear index tumbling all the way down to 37. We have officially crossed deep into fear territory. The euphoric vibes from last month's all-time highs are completely gone, replaced by anxious traders clutching their cash and questioning the durability of the tech rally. Our top story of the day is the massive global semiconductor rout that caught everyone off guard. Taiwan Semiconductor posted an absolutely mind-blowing quarter, beating profit expectations by a mile, but the market didn't care. Investors panicked when TSMC announced they are raising capex guidance significantly, which Wall Street interpreted as severe margin pressure rather than long-term demand. The sell-off spread like wildfire, slamming Nvidia, AMD, and memory giants, turning the tech sector into a casino of raw emotion. Next up, earnings season delivered a massive reality check to the streaming king. Netflix shares cratered nearly 10% today, hitting a fresh 52-week low. While they technically managed to beat earnings per share estimates, they missed revenue expectations and issued a very downbeat guidance for the upcoming summer quarter. Investors are sweating over slowing subscriber growth and rising production costs, making this a highly disappointing chapter for the stock. Finally, geopolitical alarms are ringing loud and clear. The United States expanded its airstrike campaign early this morning, striking key bridges and a port tower. This escalated conflict has pushed Brent crude skyrocketing past $86 a barrel. Traders are terrified that shipments passing through the crucial Strait of Hormuz will face severe blockades. High oil prices are driving bond yields up, threatening to choke economic growth and put further pressure on equities. Time for the lightning round, where we look at the heroes and zeros of the day. We saw incredible double-digit swings on both sides, driven by desperate speculative trading and sudden earnings surprises. Let's kick things off with the green team. Leading the charge today were LCID, SLS, Orca, and WU. Lucid Group caught an unexpected spark, jumping significantly as EV buyers look for value. Cella's Life Sciences surged on positive biotech trial data, while Oruka Therapeutics and Western Union managed to defy the broader market gravity, bringing major relief to the bulls who held strong through the storm. Now, for the painful side of the ledger, the top four biggest losers weighing down portfolios today were ISRG, CDNs, PNG, and NFLX. Intuitive Surgical dropped an eye-watering 11% despite beating earnings due to fears over slowing surgical procedure growth. Cadence Design Systems got caught in the broad chip sell-off. Penguin Solutions tumbled, and as we mentioned earlier, Netflix took a brutal 9.4% haircut. Ouch! Let's talk charts and look at the technical damage. For the S&P 500 tracked through SPY, we just saw the first major crack in the broad index. The crucial support zone between 745 and 747 was shattered post-close. Bears are now eyeing psychological support at 740. If the bulls want to stage a comeback, they must reclaim the 750 resistance level fast, or things could get much uglier next week. Over on the tech-heavy NASDAQ, tracked via QQQ, the chart is looking vulnerable. After a massive multi-day tech slide, QQQ is sitting right above critical support between 690 and 693. A breakdown below 690 could trigger cascading algorithmic stopouts. On the flip side, any relief rally faces heavy resistance overhead at the 700 to 703 level. Small caps didn't escape the pain either. Looking at the Russell 2000 via IWM, the index is hovering precariously near the 290 line. Traders need to watch this 290 level like a hawk, because a breakdown here confirms a broad market-wide risk-off environment. Resistance remains firmly capped at 295. Switching over to the digital asset space, crypto markets were pulled right down along with equities. Bitcoin is fighting a fierce battle, trading down 1.3%, right around the $63,027 mark. Hawkish Federal Reserve minutes and massive spot ETF outflows have cooled off retail enthusiasm. Key support sits heavily at $62,000, while a massive wall of leveraged long liquidations creates fierce resistance up near $68,000. Ethereum followed the leader, sliding down to retest key structural support near $3,300. The smart contract pioneer is experiencing lower transaction volumes and weak exchange-traded fund inflows, keeping the price pinned down. Bulls desperately need to reclaim the $3,500 resistance level to clear the bearish clouds. As for the rest of the altcoin market, it was a sea of red. Total crypto market capitalization has shed billions, falling back to $2.17 trillion. Regulatory friction and a complete lack of retail participation mean that Layer 1s and DeFi tokens are taking heavy damage as capital flees high-risk assets for safe haven cash. As we head into the next session, market sentiment is clearly leaning bearish and cautious. Fear is dominant, but extreme fear often sets up contrarian bounces. Keep a very close eye on the upcoming UMich Consumer Sentiment Index and inflation expectations early next week to see if consumer confidence is truly cracking. If you enjoyed this daily breakdown and want to stay ahead of the game, make sure to smash that like button and subscribe to the channel right now. See you in the next one.